Now, 2023 is almost over, and next year is starting, 2024. And at the end of every single year, I like to kind of sit down and start organizing my plan on what I'm going to do with my money. And whenever you don't do this, whenever you don't have a plan, whether you make more money next year or whether things go great for you, well, you're probably not going to progress as far as building wealth because you don't have a plan and you don't know what your money is actually supposed to be doing for you. So in this video, I'll tell you exactly what I'm going to be doing with my money for the next year, what my plan is, why that is my plan, because it's not just about what I'm doing, but it's also about why I'm doing what I'm doing, okay? What am I investing into? With who am I investing into, okay? Why is it that I invest the way I invest, okay? And what is my plan? Is it just investing into stocks or is it real estate? There are a lot of questions I'm basically going to try to answer in this video. Now, do me a favor and smash the like button. And the first thing I want to say, guys, is this. Before you start investing, I highly recommend you fulfill these two requirements first. First, be debt-free. Second, have at least a 3 months emergency account with 3 months of your monthly expenses, at least as a minimum. Tell me, why would I do that, okay? The answer is, if you have a bunch of debt, the Bible says the borrower is slave to the lender. And it's very true because you have income, but every single month you have to pay credit cards, you have to pay your car loan, you have to pay this, and it's just a lot, okay? And on top of that, it costs you a bunch of money. And it's very hard to try to get rich when you're paying somebody 12 or 18% of your money when you're only going to be earning with a decent investment around 10 to 12% overall. So it kind of like cancels things out and it adds more stress. So try to pay off all your debt except the mortgage before you start investing. And then have an emergency account. Tell me, why do I need an emergency account? Because if something does happen, not if, when something does happen, you want to be prepared so it actually doesn't affect you a ton. That's the idea. So this way you have time to get another job, or you have the money to repair your car, if you have the money to travel because a family member just passed away or whatever it is, okay? That's the idea. Now, number two, guys, is with who am I going to be investing? Who is my broker? The answer is I invest all of my money just with Vanguard. That is it. And why do I invest my money with Vanguard? The answer is Vanguard has been around since 1975. They basically funded the entire index fund. They're so large and massive and have great customer service. The point is, when you're trying to invest your money for your livelihood, for a long period of time, you don't want to be investing with the most known companies, the ones that have a bunch of ads, the ones that are always marketing themselves, the ones with all these little gimmicks about, hey, I'm gonna have this pie, I'm gonna have fraction this or fraction that. The answer is you want to put your money in a place where it is safe, where it has a great reputation, where it is massive and large. And why? Because guess what? If you were to hear tomorrow that Vanguard lost everything, the answer is that would just be so crazy and shocking, because it would mean that the entire financial market would be basically collapsing, because that's how much money Vanguard basically has, okay? So likelihood is very low. On top of that, they have very low fees, and I like that. That's a great selling point for me. Now, Tommy, what exactly do you invest into and why? The answer is not that sexy at all, okay? My only investment right now is into the S&P 500. That is the only thing I invest my money into. That is the 500 largest companies in the US. Now, why do you just have one investment, okay? Isn't that risky? Well, I have 5 reasons why I actually invest this way. First of all, you have historical returns. The average return for the S&P 500 is a little bit above 10%. And to me, that's more than enough because it beats out inflation, which is about 3.5%. It beats out the taxes, the fees, and I still get to keep a proper return. That matters a lot, okay? And history matters a lot when it comes to your investments. Number 2, compared to other investments, it is great. And here's why. Because when I put my money into the S&P 500, I know for sure I'm taking on less risk, it's less work, and I also get a good return for doing what I do. That's basically it. It's not that complicated. I'm not trying to pick stocks. I'm not trying to sell this and buy that. Don't got to do any of that stuff, okay? Number 3, risks of default. The answer is, guys, when you make an investment and it is your livelihood, like for your retirement, you really want to make sure that if that goes bad, like it has to be like the craziest thing ever. Because think about it, okay? The S&P 500 contains the 500 largest companies in the United States of America. So if that goes down to you losing all your money, it basically means the US is no more. If the US is no more, what do you think is happening to foreign countries? You see what I'm saying? So it's like, for that to happen, it's so massive that at that point, probably nothing matters, including your money, okay? And the fourth reason I actually invest this way is basically because of personal bias. This matters a lot. Are you more likely to keep your money invested in your own country with companies you actually know and understand, or into a foreign country where you don't know what's actually going on over there, where their politics, where their regulations, with the companies that actually have? The answer is most likely with your companies, okay? So it's a personal bias. You know, I live in America. The United States is the best economy in the world, and that's why I basically like it overall. By the way, I should add, I don't live in America. I live in the Dominican Republic. However, that's the country I invest my money into, okay? And number 5 and last, the expense ratio, which is basically the fees. You're being charged 0.03%. Guys, 0.03%. That is less than 1%. That is less than 0.10%. That is less than 0.25%. You're basically being charged almost nothing, okay? And it's because the fund doesn't really have to do anything. All they do is basically use your money to buy those funds. They're not trying to sell anything or whatever. And that's basically it. So it's very cheap to invest this way, which basically means more money in your pocket, which is something that everyone likes. And by the way, guys, if you actually want to read more about this subject, which I recommend because this way you'll have more conviction, read A Random Walk Down Wall Street. Read the little book about common sense investing. Read The Simple Path to Wealth. Read Barebone Investor. And just read those books and get like a concrete idea about investing overall. And also watch Warren Buffett and his regular like shareholders meetings where he recommends that regular people just invest into the S&P 500 because it's more than enough. If you read those things, and it took me a while to read all those things, you actually get conviction. Because when I first started investing, I did not invest this way. I had multiple companies, okay? I started off with individual stocks. Then I did, for example, a lot of little like ETFs and index funds into different countries. But then I realized it doesn't make sense to actually invest that way. Now, lastly, guys, you're probably thinking, Tommy, I get all this stuff, but where's the actual plan? Well, first, I had to lay down the foundation to what I invest into, with who I invest, and also those things I want you to do before you invest. But overall, it's very important that you also know when I plan to take money out of my investments. The answer is I plan to take between 2 to 3 to 4% to even 5% of my investments annually as a total. Now, the reason you actually want to do this and not take, for example, 10% or 12% or 15% of your money is because then you increase the likelihood that you're actually going to run out of money. Now, I don't just want you guys to take my word for it. Here is actually a sheet that actually shows this, and I want to show you guys right now, okay? So this right here, this paper you see over here on my left, I think it is, actually shows you the success rate based on your portfolio. So remember, my portfolio is just into the S&P 500. It is only stocks, and here's what it actually shows you. I'm gonna try to zoom in so you can actually see everything right here. Now, as you can see, here's what it says: retirement portfolio success rates by withdrawal rate, portfolio composition, and payout period. So let's say, guys, for example, that here I am right here, okay? So let's say, for example, that you have 100% stocks. If you take out, for example, 3%, you have a 100% success rate that you're not gonna run out of money in 30 years. 4%, 98%, 5%, 96%. So meaning, if I stick to below like 6% or so, I have a very high success rate. I'm actually not going to run out of money. And to me, that's all that really matters. But if you try to take out a bunch of money over like at 10%, it's like 50-50. You don't know if you're gonna run out of money or not. So I wouldn't take those odds. I wanna be like around 96 to 100. That's the idea. Now, the minute you start adding it into your portfolio, let's say, for example, like stocks and bonds, what happens is your odds actually increase when it comes to you not running out of money. However, do I recommend you actually get bonds? The answer is, for me personally, I don't like bonds Because when you actually take a look at stocks versus bonds, the way I invest basically, stocks are going to outperform bonds, like usually 100% of the time. And if you are investing over the long term, it doesn't really matter because you're not looking, for example, for a smooth ride. What you're looking for is a good return. So yes, if you add bonds, you can actually take out 4%, but then you will have less money because bonds would have basically made your portfolio earn less money. That's the idea. So for me, I'm better off personally just withdrawing like around 3 to 5%, and to me that is more than enough. Now, what am I actually using that money for? The answer is I'm not really using that money for, like next year, for example, I'm probably going to take out 5% of my portfolio. 5%, which is actually a good chunk. And what I'm actually going to use that money for is going to be to invest into real estate. So whenever I'm going to be investing, I'm going to take out more money, like at the 5% cap. But whenever I'm going to take money out for living, I'm going to try to stick to like around 2 to 3% because that's money is just going to basically be dead in a way because that's money's going to be spent. But if it's money for investing, then it doesn't hurt me to basically grab it and invest it somewhere else because then you create a little bit more diversification. So I have my savings and I can take 5%, maybe buy a property and do that, for example, every X amount of time. That's the idea. But now here's my overall plan so you guys can actually get it. My idea is to keep investing at least 20% of my income. So every time I get paid, I want to set aside 20%, but I'm not going to put it in the stock market, at least not right now, because I have enough money in the stock market to cover all of my expenses. So I'm not trying to keep putting more money in there because there is the problem that if the stock market does take a hit, then I might have to, for example, take out a larger chunk if I also do lose my income. And I'd rather worry more about cash flow now that I have that money secured in the stock market. So basically saying, I'm going to grab my 20% for investing plus my withdrawals, use that money to buy real estate. With real estate, that money gives me cash flow every single month. I'm going to grab that cash flow plus the withdrawal plus my savings and buy more real estate. Now, when will I actually start spending this money? Well, when I need to. That's the idea. I'm not going to grab this money to throw a party, to buy things I don't need, because for the most part, all I need is shelter and food. That's basically all you need, and the Bible says so. So that's the idea. So when I actually do need to have more money or whatever, and I have enough overall with my investments to actually cover me on both sides, the answer is then I can start taking out some money to actually live in a way and cover my basics. But in the meantime, there is no need as long as I have my income to actually sustain what I'm doing, okay? So does that make sense, guys? That's the idea. So I'm planning to just grab 20% of my income for investing, take money from my stocks, 5%, use that money to buy property, then use all incomes basically to keep buying more property, more property, more property, more property. And then if I lose my income, then I'm going to say, or if I want to quit or retire, then I'm going to say, okay, then, only then I'll start taking out like 2 to 3% of the money to actually go ahead and basically live off of it. But that's the idea. So for 2024, I'm just trying to save a good chunk of money to buy myself my first rental property without touching the money I have set aside to buy a personal property, because that's going to be the first primary thing I need to do. But guys, comment down below and let me know if you want me to make a full video about how to get debt free and how to build an emergency account, okay? Make one video about those two subjects. I have videos individually, but I don't have one on both, okay? Let me know if you want to see that. If you do, I'll get to work. And as always, if you want to watch more content, here is another video. Thanks for watching. Like and